Welcome back. Over the past few discussions, we have been closely examining what Kody and Robyn appear to have been doing behind the scenes, particularly their alleged efforts to silence Meri at a very critical financial moment. What has emerged is not just a disagreement over property, but a much larger pattern that raises serious questions about power, money, and accountability within the family dynamic. At the center of this controversy is an alleged attempt by Kody and Robyn to pressure Meri into signing a non-disclosure agreement. According to information that has surfaced, this move came at a highly strategic time, just as the sale of the Coyote Pass property was approaching completion. The timing alone is significant. Rather than being a routine legal step, the proposed NDA would have required Meri to waive her legal rights entirely, including the right to bring any future claims against them. In effect, it would have protected Kody and Robyn from any accountability related to the money Meri had contributed over the years, while simultaneously forcing her into silence. Meri, however, did not agree. Acting through her legal representatives, she refused to sign the NDA. This refusal reportedly led to conflict and legal back and forth, but ultimately, the property transaction went ahead without the agreement in place. That outcome alone suggests that the NDA was not legally necessary for the sale, but rather an attempt to secure protection and control beyond what was reasonable. At the time the Coyote Pass deal was finalized, Kody and Robyn were positioned to walk away with approximately $750,000. This figure represented their share of the sale, before deductions such as agent commissions and closing fees. Importantly, this was not their only recent financial windfall. Only months earlier, they had sold their previous home in Flagstaff for close to $1 million. Reports indicate that roughly $400,000 from that sale was used as a down payment on their current residence, reducing the mortgage to around $1.6 million. Even after that payment, they were still left with several $100,000 in liquid funds. Taken together, these transactions meant that within a relatively short span of time, Kody and Robyn had access to well over $1 million. This context makes later financial decisions all the more puzzling. On the television program, Kody claimed that selling Coyote Pass was necessary for him to qualify for the mortgage on their current home. However, public records indicate that the home had already been purchased before the Coyote Pass sale was completed. That contradiction raises an obvious question. If the sale was not required to secure the mortgage, what exactly happened to the proceeds? A logical assumption would be that the money was used to pay down the mortgage. For someone approaching their late 50s, reducing long-term debt would seem not only sensible but necessary, particularly when monthly payments reportedly sit in the range of $12,000 to $13,000. Such payments are difficult to sustain under the best circumstances and become even more precarious when the future of the family's television income is uncertain. Yet events that followed suggest that the money may not have been used in this way. After Meri declined to sign the NDA, the financial arrangement of the Coyote Pass sale reportedly changed. Instead of receiving a much smaller fractional share, Meri secured a significantly larger percentage. Not long after this adjustment, Kody and Robyn recorded a second mortgage on their home for $750,000. The details of this transaction are striking. On the 31st of December, Kody and Robyn visited a title company and secured a home equity line of credit with a maximum limit of $750,000 plus interest. The agreement allows the lender to make advances on a revolving basis, meaning funds can be borrowed, repaid, and borrowed again, much like a credit facility secured against the property. The loan does not mature until January 2056, making it a 30-year obligation. This is highly unusual. Most home equity lines of credit are structured for 10 years, not 30. The sheer size of the credit line is also remarkable. A HELOC of this magnitude is effectively a cash advance on the home's equity, typically used when an individual is asset-rich but cash-poor. It provides access to funds for various purposes, but it comes at the cost of placing additional long-term risk on the property itself. Common reasons for taking out such a loan include major home renovations or necessary structural improvements. However, available permit records indicate that no renovation work has been planned or approved for the property. There is no evidence of construction, refurbishment, or expansion that would justify this level of borrowing. That fact alone makes the decision deeply questionable. The loan agreement does not specify how much money was drawn initially. It does not state that $750,000 was released in a lump sum. Instead, it establishes a revolving credit limit, allowing the borrowers to access funds as needed. In practical terms, this means the line of credit can function almost like a personal bank account, backed by the value of the home. What makes this situation even more curious is Kody and Robyn's financial history. In the past, they have refinanced properties relatively quickly after purchase, often utilizing adjustable rate mortgages with short-term rate locks. They have also previously structured mortgages using both first and second loans to avoid paying private mortgage insurance. In those cases, the loans were clearly tied to the purchase or refinancing of the property. This time, however, the circumstances are different. The primary mortgage was already in place at approximately $1.6 million. Given the timing, it appears plausible that a substantial payment may have been made to reduce that balance, potentially using the proceeds from Coyote Pass, only for the same amount to be borrowed again less than a year later through the equity line. The coincidence is difficult to ignore. The credit line is for the exact same amount they reportedly received from the Coyote Pass sale. For this type of transaction to be approved, lenders typically require the borrower to maintain at least 20% equity in the home. No lender would allow a second mortgage that pushes the loan-to-value ratio to 100%. This strongly suggests that equity had been increased prior to the HELOC being issued. If that is the case, the implication is clear: the money from Coyote Pass and the earlier home sale may have already been spent. The HELOC then becomes not a strategic financial move, but a necessity, an effort to replace cash that is no longer available. Taken together, these events paint a troubling picture. What all of this ultimately points to is one unavoidable conclusion. Kody and Robyn live an exceptionally expensive lifestyle, and money appears to leave their hands as quickly as it comes in. When you start adding up the figures, it becomes difficult to ignore how rapidly substantial sums seem to disappear. The obvious question is where that money is going. While there are some predictable expenses, such as child support payments for truly and potential legal fees, those costs alone do not come close to explaining how such a significant amount of money could vanish in such a short period of time. There have been no public records indicating the purchase of additional property, no new investment homes, and no major land acquisitions. Instead, what we do know is that Kody and Robyn have long demonstrated a taste for excess. Over the years, they have filled their homes with expensive items, decorative objects, jewelry, collectibles, and an almost constant flow of non-essential purchases. Their spending habits suggest comfort with indulgence rather than restraint. However, even taking that into account, it strains credibility to believe that close to $1 million could be spent purely on household items and personal luxuries in such a short window of time. This raises other possibilities. Could they be preparing to repay Meri? Could they be anticipating legal action and quietly building a financial buffer to cover potential legal fees? While those theories might sound reasonable at first, they quickly fall apart under scrutiny. If the money were truly being set aside responsibly, there would be little reason to secure a massive home equity line of credit. Doing so would actually suggest the opposite, that the funds are not available in liquid form and must be borrowed against the property instead. If we assume, for argument's sake, that the $750,000 received from the sale of Coyote Pass was put directly into the house, that still leaves a glaring issue. It would mean that the proceeds from the earlier sale of their previous home have already been exhausted. Any equity they might have built, any opportunity to significantly reduce their loan-to-value ratio, appears to have been disregarded. This is not the behavior of someone focused on long-term financial stability. It suggests that the house is not being treated as a secure asset, but rather as a financial tool, a reserve to be dipped into whenever cash runs low. Using a home as a financial safety net in this way is risky, particularly when the mortgage balance is already high. Taking out a $750,000 home equity line of credit less than a year after purchasing a property is not something people in strong financial positions typically do. In fact, such a move often signals financial strain. A HELOC of this size is extremely rare, and most lenders would not approve it unless there was a clear justification and sufficient equity to offset the risk. The broader context makes this decision even more concerning. The future of the television program that has supported this lifestyle for more than a decade is uncertain. There is no guarantee of continuation beyond the current season, and no reliable indication of how much income may remain once filming concludes. Structuring finances in a way that relies on continued high earnings while simultaneously increasing debt is a precarious strategy at best. Even if the purpose of this loan were to repay Meri or resolve outstanding financial obligations, it would still expose a deeper problem. It would indicate that Kody and Robyn do not have the liquid assets required to meet those obligations outright. That alone is astonishing when you consider how long they have been earning from reality television. After 15 or 16 years of consistent income, one would reasonably expect a substantial cash reserve, funds held specifically for situations like this. Individuals who are genuinely financially secure tend to maintain accessible savings, whether through cash accounts, diversified investments, or other liquid assets. These reserves are essential not only for maintaining a comfortable lifestyle, but also for managing unforeseen circumstances, disputes, or legal matters. The absence of such reserves suggests that income has been consistently spent rather than preserved. What this pattern reveals is a cycle of immediate consumption. Money comes in, money goes out, and little appears to remain. There is no visible emergency fund. There is no evidence of funds set aside to repay Meri, to compensate Janelle, or to handle financial disputes responsibly. Instead, when funds are needed, the solution seems to be borrowing against the home. For most people, a home represents long-term security. It is meant to be protected, not leveraged repeatedly to cover ongoing expenses. Once you start stacking debt against a primary residence, particularly in an inflated housing market, you expose yourself to significant risk. Interest rates fluctuate, property values can decline, and economic conditions can change rapidly. History has already shown how quickly housing markets can collapse, leaving homeowners dangerously overleveraged. The risk is even greater when a property is purchased at the peak of the market, as appears to be the case here. High purchase prices combined with rising inflation and uncertain income streams create an unstable financial foundation. If property values were to decline, the equity that currently supports this massive line of credit could evaporate, leaving the household exposed to serious financial consequences. To illustrate the contrast, consider how financially conservative households typically operate. Many homeowners purchase their property with the intention of paying it down steadily over time. They make additional payments when possible, avoid refinancing unless absolutely necessary, and treat equity as something to preserve rather than spend. In such households, home equity is not viewed as disposable income, but as protection against future uncertainty. Even when faced with unexpected challenges, such as legal disputes or sudden expenses, financially prepared individuals rely on savings rather than debt. They plan ahead, maintain reserves, and avoid compromising their long-term stability for short-term relief. The behavior displayed here suggests the opposite approach: spending first, borrowing later, and relying on property value as a constant fallback. This approach is especially troubling given the length of time Kody and Robyn have had to prepare financially. With more than a decade of high-profile income, there has been ample opportunity to establish savings, investments, and contingency plans. The apparent absence of these safeguards indicates a pattern of financial mismanagement rather than isolated poor decisions. Ultimately, the conclusion becomes difficult to avoid. The money from previous property sales appears to be gone. Not allocated responsibly, not preserved for future needs, but spent. To truly understand how precarious this situation has become, it is important to look at the wider housing market context. In the years leading up to the last major housing collapse, people went on what can only be described as a borrowing frenzy. High-risk lending was commonplace, subprime loans were approved with minimal scrutiny, and many buyers were qualified for mortgages they realistically could not afford. When the market eventually crashed, the consequences were devastating. Since then, lending standards have tightened significantly, and although the market recovered gradually, the last several years have seen housing prices rise at a pace that simply cannot be sustained indefinitely. While I am not a financial advisor, I do have professional experience in mortgage lending, and one thing is always consistent in housing cycles: rapid growth eventually slows. That slowdown does not always result in a dramatic crash, but it does almost always lead to cooling. Prices stabilize, demand softens, inventory increases, and buyers become more cautious. There is usually a window, a sweet spot, where buyers who enter the market at a low point and remain there long term are insulated from these fluctuations. Those who buy at the peak, however, take on far greater risk. Buying at the top of the market is inherently dangerous. A property purchased today may not appreciate meaningfully next year, and in some cases, it may even lose value. That is precisely what appears to be happening in Flagstaff at the moment. Market data shows slower price growth, increased inventory, fewer pending sales compared to peak periods, and longer times on the market. The housing shortage that once drove prices upward so aggressively has eased, and demand is no longer outpacing supply at the same rate. Kody and Robyn purchased their current home for approximately $2.1 million in 2024, right at the peak of the market. This is a critical detail. In previous years, property values in the area were increasing dramatically, sometimes by $100,000 to $200,000 annually. Their earlier home, which they purchased for just under $900,000, nearly doubled in value within 5 years. That was a textbook example of buying low and selling high. Unfortunately, what followed was the opposite. After capitalizing on a strong market and selling at a peak, they re-entered the market at another peak. 1 year later, estimates place the home's value at only around $16,000 above the purchase price. On a property of this size and value, that level of appreciation is negligible. It is a clear sign of a cooling market. In practical terms, it means they have gained almost nothing in equity while taking on enormous financial risk. This pattern of decision-making reflects extremely poor financial judgment. Rather than preserving the advantage gained from selling at the high end of the market, they immediately placed themselves in a far more vulnerable position. Instead of securing long-term stability, they increased their exposure to market volatility. When you add rising interest rates, inflation, and uncertain income streams into the equation, the risk becomes even more pronounced. The emotional conflicts now playing out publicly, deflections, accusations, and shifting blame, begin to make more sense when viewed through this financial lens. Claims of jealousy, power plays, and betrayal are distractions from a far more uncomfortable truth. These disputes are not about pride or ego, they are about money. Specifically, they are about obligations that cannot be met. There is a very real possibility that Meri could pursue legal action. If that is the case, the large loan taken against the house may be intended to prepare for that outcome. However, doing so only compounds the problem. Borrowing to settle debts does not resolve financial instability, it deepens it. It increases long-term obligations and reduces flexibility, particularly when income is uncertain. The reality is that once the television program ends, Kody is unlikely to find another opportunity that provides the same level of income with the same consistency. Reality television is a rare platform, and sustained success over more than a decade is even rarer. The incentive to keep the show going is therefore enormous, not because of passion or storytelling, but because the current financial structure depends on it. A 30-year mortgage, coupled with a massive second loan, effectively locks them into needing high income for decades. Yet the program is already showing signs of decline. Viewer fatigue, shifting narratives, and public scrutiny all suggest that its lifespan may be limited. If the show were to be cancelled within the next 2 to 3 years, maintaining this level of debt would become nearly impossible. Under those circumstances, bankruptcy would not be a distant possibility, it would be a likely outcome. In many ways, the situation already resembles insolvency. The only difference is that assets still exist to borrow against. That does not indicate wealth, it indicates a lack of liquidity. It means money is tied up, spent, or otherwise unavailable, forcing reliance on debt to meet obligations. This explains the ongoing conflicts with Meri and Janelle. These disputes are not emotional misunderstandings, they are financial standoffs. The money simply is not there. Even after receiving substantial proceeds from property sales the previous year, there are no accessible funds to resolve outstanding obligations. That fact alone speaks volumes. For individuals who have earned significant income for over 15 years, the absence of cash reserves is alarming. Most financially responsible households maintain emergency funds, investment accounts, or liquid assets precisely to avoid this scenario. The lack of such reserves suggests a pattern of spending that prioritizes immediate gratification over long-term security. What we are witnessing now is the consequence of that pattern. Debt has replaced savings. Equity has replaced cash. And conflict has replaced accountability. The house is no longer a home or an investment, it is a financial crutch. As market conditions continue to shift, the margin for error narrows. If property values stagnate or decline further, the safety net disappears entirely. At that point, there is nothing left to borrow against, and the full weight of these decisions becomes unavoidable. In the end, the financial reality is far more damaging than any on-screen argument. The numbers do not lie. Income has been spent, not preserved. Debt has been accumulated, not reduced. And now, the future hinges on a television show that may not last long enough to support the structure built around it.